Founderama, another episode. We're continuing this week with the theme of financial kind of ideas. And today we're talking about building financial projections that investors will love. So, financial projections are an important part of a pitch deck. But it's not just about the pitch deck, it's not just about um, when you're seeking funding. Getting to know this topic, understanding this will help you not just for seeking funding, but in your business as well. So let's dig into this. I'll be talking about creating accurate and compelling financial projections, including defining your key metrics, understanding your market size, projecting revenue, estimating operating expenses, forecasting cash flow, and performing sensitivity analysis. Well, not in that particular order, but these are the concepts that I will be kind of looking into. And of course, these kind of financial projections in your pitch decks will make you attractive to potential investors. First of all, let's start with knowing your market. Start with conducting a thorough market research. How do you do that? First of all, you identify your target market size. Now, and yes, you're probably getting a little bored of this by now, but these are fundamentals that I want to really drill into your subconscious so that they become second nature to you, that you don't necessarily have to think about them, because when they become second nature, you won't make a mistake. Knowing your target market size is an art in itself, but you got to be really specific. Don't just go for these big TAMs, right? So, total addressable market in the billions and the trillions. They could be, but be more realistic. Understand industry trends and customer behavior. So, if you had an idea 2 years back and you've been thinking about it, you've been looking into it secretly, and then suddenly, today you feel like, okay, now is the time, or you've been doing a little bit of work, bootstrapping it, but have not really assessed your original idea and validation and where the industry is now, you may head into disaster. So now is the time to look at industry trends and customer behavior. Now, one of the best ways of understanding the market and where you are is by benchmarking against competitors, right? By analyzing your competitors' growth rates, pricing, and financials, if you can get access to those, it gives you a really good idea where your financials are or should be, and if you're on the right track. Then, of course, use data to refine your assumptions. Because look, the market changes really rapidly. Consumers change, technology changes, trends change. And these days, back in the day when I got into investing as a angel investor, and then I set up my incubator. I got in a few partners. We got leveraged with a VC, and then we started investing. Industry changes used to take a little while, right? And they were either numbered in years or months. But right now, it's either months or weeks. Things are changing. If you have an idea today about, I don't know, a solution that leverages ChatGPT to address a problem that ChatGPT interface does not have, or the public access does not have, that could change in a couple of weeks, right? In a few weeks, ChatGPT 5 or 6 or 7 or whatever may come out, and whatever you're trying to address may be gone. So look at it, right? So that's very important. Next, revenue projections. Break down revenue streams. This is very important. Look, your business could have a primary revenue stream, right? But if you don't actually break down and look for opportunities to have additional revenue streams, you will never see them. That depends on your product or service pricing, of course, right? So evaluate the product service pricing and say, is this the only revenue stream that we can get? Or could we change the pricing or the model or the strategy in such a way that we could have multiple streams of revenue or multiple revenue streams, right? Look at all your sales channels, look at customer segments, and see um, if there's an opportunity to segment your customers or your sales channels in such a way that you can generate additional revenue. A lot of founders actually miss this bit. They not because of the lack of interest, but because they're so busy, they're so close to the ground, they're so close to the situation that an obvious, sometimes maybe not, revenue segment stream they may miss out on that, right? So pay attention to this, analyze and look at different angles and say, okay, we're having this sales channel, which is LinkedIn, and we're trying to get our leads on LinkedIn, blah blah blah. What about Instagram? Oh, no, no, no. Our business is, I mean, who is gonna buy this on Instagram? Really? Instagram has changed. Whatever you sell on LinkedIn can be sold on Instagram now. Maybe not the same amount, but we're talking about additional revenue streams, right? So think through. Use a bottom up approach, right? So, bottom up approach, which is you calculate the addressable market, you estimate conversion rates and sales growth, and then you account for seasonality and other fluctuations, right? So, bottom up approach is where you're looking at the addressable market, but then you also look at conversion rates and sales growth. And then you try and find revenue projection based on this. Okay, so just to clarify this, how do people typically, um, uh, you know, come up with revenue projections? If you're already having sales, that's fantastic, right? So that's what this is about. Revenue streams are based on your different sales channels and all that. But let's say you have some sales. So you have, let's say, $5,000 MRR, monthly recurring revenue. And you then project that, taking into account maybe a 20% increase every 6 months, every year, every quarter. It depends. It depends on your strategy. Depends on your market, and maybe you are going to add some features in the next 3 months that will allow you to increase your price, which means your revenue. So you take it, all these things, and then you project your revenues, right? Now, conversion rates and sales growth can be important points in figuring out the right kind of revenue projection. Now, I'm not asking you to be too diabolically optimistic and put some ridiculous numbers on the slides. In fact, I am completely against it. I always talk about erring on the lower side rather than the upper side, because what do I say? If you've been watching my live episodes, you know what I say. Investors are not fools, right? So be practical, be authentic. But here, what I'm talking about is looking at projections and extrapolating reality, right? And then, of course, account for seasonality and other fluctuations. Add those things in so that your revenue projections look authentic, are authentic. Expense projections. Now, categorize your expenses. When in your pitch deck, expenses have to be categorized at a micro level. Now, there is a school of thought. People say, oh, if we're too detailed, the investors, they'll find it boring. No, they will not find it boring. And you know what? There are people who say minimum, go for a minimalistic approach. Less is better. Good for them. If it's working out for them, and they're getting the funding they need, good for them. But I'm speaking from my experience, right? And I work with hundreds of founders. I've facilitated over $35 million in funding for founders, and I speak from that experience. So categorize these fixed costs: rent, salaries, software subscriptions. Yeah, the reason I'm including this is people might say, what? Yes. Variable costs, marketing, raw materials, shipping, if you're if it's a product-based situation. Then prioritize investments, right? Focus on areas with high return on investment. If you're seeking $500,000 or if you're seeking $1 million, then prioritize that. And all right, my camera is acting up again. Is it? It's, yeah. Okay. So focus on areas with high return on investment, right? So when you break up that investment that you're seeking, yes, you're gonna pay the team, which is a high priority. You could say marketing, and then you might throw in something like Google advertising spend, and 20% of the funding is going to go into that because it's a part of your go-to marketing strategy. Now, is that a high return on investment? That is critical. It could be. I'm not saying it's not, because it's depends on the situation. But those are the things you need to look at, right? Those are the things you need to break down in the pitch deck. Be strategic about scaling operations. So if you're seeking funding and a huge chunk of that you want to put towards scaling, make sure that that scaling happens on the back of traction, right? If your user base is growing, your revenue is growing, then make sure you're scaling that part that is leading to that revenue growth. Because look, the 80-20 rule, right? 80% of your revenue usually comes from 20% of the marketing strategy, the marketing campaign, the activities, right? And people don't believe this. In fact, a lot of people spend 80% of their resources on things that only bring back 20% of traction. That's what you need to kind of analyze here, right? So be strategic about scaling operations. Then plan for contingencies with a buffer. In the investments you seek, if it's $1 million, leave aside a buffer, 20%, 10%, and say contingencies. And don't be afraid to do that. Don't try to use up the entire funding that you're seeking and allocate it. No, leave aside a little bit of buffer. That buffer depends on your kind of business and the runway and all that, right? Next, cash flow projections. Understand cash flow versus profitability. This is very important. Cash flow versus profitability. A lot of people think cash flow is it. They don't have to think about profitability because, hey, we're just starting out. You gotta think about profitability from day one. Next, create a monthly cash flow forecast. Highlight cash inflows and cash outflows. And these are major cash flows, right? Next, monitor working capital. Model your working capital so that it relates to the cash flows, but you're also looking at the whole model. Develop strategies to optimize cash flow. So find bottlenecks in your cash flow. What is it? Your raw materials, maybe. Could you negotiate instead of 30 days, maybe a 60-day payout? If you can, that's going to optimize your cash flow. That's fantastic. Investors love to see that. If you have done that, include it in the pitch deck. Say, this is the original cash flow. We've then negotiated with this vendor, with this supplier, with this team, whatever, and now it's this. Investors love that. So, shorten payment cycles. Exactly. Negotiate better payment terms. These are the things I've just described. Next, key performance indicators, KPIs. Ugh. Select meaningful KPIs, right? Growth metrics, select revenue growth, user acquisition, for example. User acquisition is the most important thing. I mean, by far, that is it. In my book, that is the holy grail. And user acquisition cost is one of the biggest metrics that you need to include in your pitch deck, right? Efficiency metrics such as customer acquisition cost, gross margin. So, as I just mentioned, this cost of acquiring a customer, the margin you're making, the profitability, all these things, all these metrics should be taken into account. Stability metrics, runway, burn rate, very important. then monitor and evaluate these KPIs regularly, right? Adjust strategies based on data-driven insights and showcase progress to investors. So this is part of it is when you're seeking funding, part of it is afterwards, um, your communication strategy with your investors. Now, in case you don't know what that is, once you get your funding, you got to have a plan and set up a process and someone responsible within your startup that is responsible for communicating regularly with your investors, giving them the information that is important to them. This could be updates on your progress, milestones, your cash flows, your revenues, things like that. Have a framework, a template, and every month, every week, depending on what are the term sheet and the agreement you have with those investors, send this out. Make sure that it is not delayed or all that, right? So share that, showcase that progress, and that's where you can then say these were the KPIs. This is the revenue projection when we came to you for funding. Right now, this is it. So is it positive? Is it negative? What about user acquisition? We predicted we're gonna make 600,000 users by this date. We're only 400,000. All those things, right? Next, presentation tips for investors. So what that means is when you're presenting these financial projections to investors, these are the tips. Be transparent and realistic. I always say this, right? So investors are not looking for outrageous numbers. They don't get impressed with numbers. They get impressed by realism, authenticity, okay? Avoid over-optimistic projections with your TAM, with your SOM, with your revenue projections, with your user acquisition projections, all those things, cash flows. Address potential risks and challenges. Don't be afraid to put down a potential risk and a challenge and then mitigate it, right? So show them how you're going to mitigate that, because problems are going to crop up. Investors are not fools. They know that. Use visual aids effectively, right? Highlight trends and comparisons. Use bar charts. Use pie charts. Pay someone to do this for you if you don't know how to. Keep slides clean and easy to read. Tell a compelling story. Connect financials to your vision and mission. So I've seen day in and day out pitch decks that come in and their financial projections are just numbers and that's it. There is no connection. There is no, this is why we are projecting this, okay? We're projecting that we're gonna get 1,000 paying customers within the first 3 months, for example. And they say, how can you do that? Oh, because of our go-to-market strategy. Oh, okay. You think your GTM is so fantastic, you're going to get 1,000 paid customers within 3 months. That's fantastic. That's fine. But then connect that with your vision. Why? Why is that? Why are you so confident, right? With your projections and things like that. Connect that to the story of your vision, your passion, all those things. Demonstrates your team's ability to execute. So this is an important thing. And this goes also onto the team slide, but also into the story slide. This is interconnected because I want to know in the financial projections, when you're doing this and you say, because of the GTM, add a blurb to say, one of our team members is a GTM specialist, or we have an advisor who's who is experienced doing this, or, tie, demonstrate. So to conclude, the importance of accurate, data-driven financial projections. Very important, very critical. You know that. The key components are market research, revenue and expense projections, cash flow management, and KPIs. Present your projections with confidence and transparency. Okay, so financial projections are an important part of your pitch deck when you're seeking funding and even afterwards. They're good they're good business skills that you can learn, not just for this startup, for the next one. You got to be careful. You got to be realistic. You got to be authentic. Think about the investor. Think about also return on investment. Learn to think like that and present that to your investors, and they will love it. Okay, so we're continuing on this theme. Tomorrow, something similar. So if you have any questions on this, leave me a DM on LinkedIn or hit me up on Twitter, and I'll try to give you my 2 cents. All right. So till tomorrow's episode, go forth and